So this week you can see I'm in a really pleasant place with a whole lot of longwood shola forests behind me and tea estates around me. Sales in Q1 for the sample of 135 companies is only up 4.7%. This time I'm in a new location. I'm floating on the Ganges, the holy city of Varanasi. We are going to have it a little different. I have some of my team members here with me today. Okay.
I mean, in this case, you actually have control of all of your properties and assets till your death, and you're not, dependent on the heir.
And then at the end of December, I was struck by a personal tragedy when I lost my mom. It's taken me some time to get back to work. European Union free trade agreement, we've had the US-India trade deal, and we've had the Monetary Policy Committee meeting today.
As we saw the war and the month, right, there was a lot of time correction and price correction which happened during that time.
Hi folks, and welcome to the 50th edition of the Weekly Wrap. You heard it right, this is the 50th edition, and we're all so happy that we are able to get this far, and it's all because of the motivation and inspiration that we've been having from all the viewers out there. And to make the 50th edition special, we are going to be answering queries from our viewers. So we have picked 5 important queries or 5 important questions that our viewers have put to us, and we're going to attempt answering all these. And the surprise is that we have leading lights from the industry giving their views too on these queries. Okay, so here goes.
Good evening, everyone. So today we have something interesting. So instead of doing the regular weekly wrap like how we do every single week, we thought we'll actually focus on what the viewers want to know. So we have a couple of questions from some of our viewers. The first one, given the huge economic turmoil created by the West Asia crisis, what in your opinion is the stress-bearing capacity of the Indian economy and the Indian market?
Yeah, this is something that's been worrying a lot of people given the war that's going on. And one can keep extrapolating, and you can extrapolate both ways always. Okay, and suppose we extrapolate that this continues for a long period of time, and the critical one, that is oil, stays above $100 a barrel. Okay, so let's keep in mind that oil has slipped below 100, and this is close to $95 today. Okay, but suppose it stays above 100 and there's no truce, then what? So we have a number of projections made by well-known economists on what can happen to inflation, what can happen to growth. Okay, and the projection is that inflation could go up to around 5.8%, and that is still within the tolerance band of the RBI, which is 4 to 6%. Okay, we are close to 4% today, 3.85 also, and we could go up to 5, 5.5, 5.8 if oil stays above. And obviously, this will have an impact on growth when prices go higher. And it is projected that GDP growth could come down by about 0.25%, and at the upper limit about 0.5%, which brings us down to a 6% GDP growth. So is this a lot of stress on the economy? No, I think the Indian economy is large enough to bear this stress, and government policies and Reserve Bank policies would be sufficient to steer us through this kind of a crisis if it happens. And it could well be that it won't happen, because we all know that both the nations are closer to a deal than they were a month ago, because both have realized the limits of their endurance. And before they break that, they would like to come to a deal. That's our thinking in any case. Thank you.
So the next question, so this is actually from a retired gentleman. So he's worried that, so in the last decade, he's saying he has moved from no market reliance to full market reliance. So what is the risk of any market implosion and any preventive steps?
Yes. So obviously he's concerned if his investments are linked to the market is volatile, and if the market corrects, then how does he make his withdrawals? Because he is making his withdrawals from this corpus, and that's his monthly income. It's a fair and valid point. But what I would like to remind our viewers is what matters is asset allocation. We have spoken about this in the past, and here once more I'm going to say that asset allocation matters. And if your asset allocation is more towards debt, you are less sensitive to price fluctuation. And if your asset allocation is more skewed to equity, then you do have cause to be worried about the volatility in the interim period. But most of our clients who are retired, they have almost two-thirds of their portfolio in debt rather than equity, and only about one-third in equity to account for inflation and provide a growth factor. In such a situation, one need not be so worried about the reliance of the market, because the volatility of debt is a fraction of the volatility that is there in equity. So I would say not to be worried if you have the right asset allocation.
So, one myth about retirement that I really think needs to be busted is that the minute you turn 60, you migrate into FD and you become a super conservative investor. Guys, please remember that in India today, for many of us, lifespan is going to be 80 to 90. So that means you're going to spend one third of your life in retirement. Your retirement portfolio cannot be just a fixed income portfolio. It has to be a well thought, well asset allocated portfolio that has equity and fixed income and a meaningful amount of growth assets. Speaking of long term and decades, I also want to take the opportunity to congratulate the incredible team at Hexagon for the work that they've been doing. We worked with them for many years and we've always been impressed by their commitment to clients and the consistency that they bring to the table. So, congratulations, guys, and happy investing to all of you.
One of our investors have raised the concern and have pointed out that many major asset classes today are richly valued. And at the same time, we are seeing persistent fiscal deficit, rising sovereign debt, elevated global liquidity, and one of the longest periods without deep global recession. In such a case, how much control do you think central banks and governments have for any large scale intervention like during COVID and in case of a serious slowdown or a financial incident?
All right. So, a number of assumptions have been made, and this is where I would like to make a point that there are some places which are richly valued and some places which are not richly valued and are fairly valued. One needs to be able to differentiate. For example, if you are looking at India, then the large cap universe today is just around fair valuation. It was at a high valuation, and after the price correction, they've come down to fair or slightly below fair valuation also. So I don't see any concern there given the growth that we have on hand over the next couple of years. But if you're looking at, say, the US market, and if you're looking at only the MAG 7, MAG 10, or some of these companies, then one could worry about the valuation. But you always have the choice of being in a market where the valuations are not so rich. Okay? The rest of the S&P 500, for example, is not richly valued, and the large cap in India is there. Emerging markets in general are not richly valued. So we have a division this time where the developed markets are above their median valuations. The emerging markets are still all right. Okay? So it's a complete reversal of the situations that we have seen in the past. And that is largely because that over the last couple of decades, emerging markets have focused a lot on strengthening the economies. All their macros are far better than the macros we see of the developed markets. So I wonder whether we should still be calling them developed markets, because their debt to GDP ratios are far higher than the debt to GDP ratios of the emerging markets. Our current account deficits are in better situation. Our fiscal deficits are in better situation. The emerging markets today have far more foreign exchange reserves than they had in the past. So all these point to a stronger emerging market today than it was a decade or so before. So you can always choose where you want to have your portfolio. Okay. Then when it comes to geopolitical fragmentation, that's a fact of life. We are seeing it. It is very different from what it was a couple of years ago. But geopolitical says political. It does not say business. So businesses find the way around crisis. That is how they survive. That is how businesses survive and they become sustainable. So while there could be geopolitical crisis, businesses adapt. That's all right. We have to go through it, we have to live through it, and invest through it, keeping this at the back of our mind. That could be my issue. And then, do we have room to support a slowdown? Here again, India's fiscal deficit is still at only 4.4%. Okay, it is not high. It is not persistent. We have been persistently bringing it down, not going up. So there is no worry. I think there is enough room in India to support a flagging economy. Okay, but does US have the same? Economists believe it doesn't because of the very high debt to GDP. I mean, about 129% is a debt to GDP, right, Dhruti? So, yes, they've been borrowing more and more, and that could be an issue. But the US also has the benefit that it's a world's reserve currency. That status is still not gone, though there's a debate. It remains. So, they can continue to borrow and take the balance sheet higher and higher. The Fed's balance sheet is bloated. So, it may not have as much room to maneuver as it had in the past. But the US is not the only investable market. There's so many other markets in the world which an investor can look at. And the emerging markets, as I said, are probably in a better position today than they were in the past. So, good diversified portfolio is a way to overcome a situation like this.
We were just talking about diversification, right? So, what, according to you, is the right balance of risk diversification across geographies for a growth phase, global profile domestic investor?
So, in the past, a few years back, when we were doing the study of how much should we have outside India, okay, and when I say outside India, it should be diversified, not just a country specific portfolio. We figured that around 20 to 25% global equity diversification is good for the portfolio. Okay. From 0 to 25, we see that there's incremental return for every unit of risk more that we are taking. After that, it plateaus out. So it means that after 25% exposure to global equities, we are not getting any significantly higher return for any risk taken. So you might as well say 20-25% or so is a good spot to have. But many investors don't want to jump to 25 straight away because of the unfamiliarity bias. Okay. But so they move up from 0 to 5, 5 to 10, 10 to 15. And one day I hope they will move to 20-25%. This is a long game, not a 1 year game.
An investor should explore investment outside of India. That is needed from geographical diversification. We have 3 neighbors, China, Pakistan, Bangladesh, where we don't share great relationships. A geographical diversification will protect you in case of any untoward incidents with them. We also need business diversification. There are businesses like Apple, Amazon, Google, which are not present in India. They can only be accessed by investing overseas. There is also valuation differential. There are times when Indian equity trades at significant premium to global market. There are times when it trades at par with them. Obviously, overseas investment from a geographical business and valuation diversification is important. How much one should allocate? That depends upon your investment objective as well as risk profile. But some allocation towards global assets, be it debt, be it equity, is absolutely needed. One perfect example in today's time, India levies between import duty and GST about 19% tax on gold and silver. If you sell your gold and silver here, take that money through LRS into overseas gold, silver assets, you will get about 19% extra in terms of volume.
So, another question, as you said, long game that we have from an investor is, how should a long term investor think about asset allocation and risk?
And does it still make sense to largely be invested because inflation erodes idle cash over time? Or is there increasing merit in holding meaningful cash reserves similar to Berkshire Hathaway's stance? And despite the opportunity cost, what's your take on it?
So I'm guessing this question is in the context of the uncertainty that is existing in the world and the weaker macros in some of the countries. And should you then be investing at all? Should you not be sitting on cash like Berkshire Hathaway is? Okay, so Berkshire Hathaway is sitting on a good $300 billion plus of cash. But we are not Berkshire Hathaway. Berkshire Hathaway goes after large deals, acquires companies at a discount based on their negotiating power. You and me don't have that negotiating power, so we have to continue putting a rupee a day into the markets. So sitting on cash is not a great idea for us because timing the market, as we all know, is very, very difficult. And if we lose that first couple of days of 5-10% jump, then the essence of waiting out in cash is gone. Keep a good time horizon and be invested. That's what I would say. And unless the macros and valuations in this particular market are screening a sell or screening a buy, there's no need to go underweight or overweight on the equity class. But these kind of things should be taken with the advice of a good advisor. Okay, doing it by yourself may not be the best. You will not have the same access to information. You will not have the same access to experience in taking such tactical calls.
Being in the personal finance journalism for many years, I get this question a lot from a lot of my readers, a lot of my friends, colleagues, family friends also, as to how to select a financial advisor. Because today, you see, when I started my career in financial journalism so many years ago in the year of 2000, markets were very simple. There weren't too many products. It was quite okay for an average person to invest in the markets on his own. But today, the markets are very complicated. There are a lot of financial products. You can invest in India, you can invest abroad. So the need to have a guiding hand is, I feel, is absolutely necessary. And it's not just about deciphering markets or the scenarios or your financial goals, etc., that you need a financial advisor. Even if you can do all these things on your own, the lack of time, the paucity of time on your hand is also, is also one big reason why you need actually a guiding hand. And according to me, if once you cross the age of 30, even your financial responsibilities also go up. You have a family, you have children, you on one side, and then you have dependent parents who are getting more and more dependent on the other side, and then you have yourself also to take care of. So and plus, of course, you have your job. So you may have the knowledge and the understanding of the markets, but you might not have the wherewithal to manage your money. So you need a financial advisor. My suggestion is that, word of mouth is obviously very, very important. Ask your close friends, family members who you trust, who already have a financial advisor, if they can recommend you one. There are websites, there are databases that you can tap into, see some financial planner names, the contact numbers in your cities, preferably in your area as well. Do some kind of a Google check to see if they have appeared elsewhere in media, or if you see them at any events. Do some basic Google search and you'll be able to spot some of them, at least, if not all of them. Always have an option to sort of speak to the 3 or 4 people. Don't just speak to one and decide upon whether you want to go with him or her or not. But I suggest that you need to at least reach out to at least 3 or 4 people. Take your spouse also along with you. If you can't meet them personally initially, then at least have a good detailed phone conversation or a video conference call. Especially have a video conference call with your potential financial advisor to understand that person's wavelength. Speak to them, ask them questions, ask them many questions, how they manage their money, what is the range of services that they can offer. Do they offer you only investment advice, or do they offer you financial advice? Can they offer you tax planning also? What are the kind of products that they deal with? Do they also do wills and estate planning? Will they help you in that as well? Because that also is very, very important today. So these are some of the things that you can check, before finalizing an advisor. And then last, after everything, when you speak to 3 or 4 people, you will get a sense, you will get a very good idea of whose wavelength matches yours, the way they talk, the way they answer your questions, are they patient enough or not? And depending on how they answer and what they answer, you and your spouse can then collectively decide as to who among them would you want to handle your money. And that's something that can come only after you interact with that person. So these are some of the finer elements that you can take a look at when searching for a financial advisor. All the very best.
So now to the $1,000,000 question. Will the market improve? And if so, when?
The big question that everybody asks. So I believe that it will improve because it has never stayed down. We've gone through enough crisis in the past, whether it was economic or non-economic or wars. We've gone through all these crises, and during the crisis, the market might have been down, but they've always jumped back from there. And however worse the crisis is, they've not remained down for more than 18-24 months. So that's all that staying power you need to be having for a recovery. So yes, will the markets bounce back? I'm very, very sure, in fact 100% sure, the markets will bounce back. It's a question of when. So when is part of the question that you are asking me. So immediately I would say that the fall was caused by 2 reasons. One was India was a bit overvalued, so it determined that rationally and logically there should be a correction. Secondly, there's a war going on. So both these have caused the markets to fall and remain low. Once the situation on the war resolves, you can be fairly sure that the markets will recover. So you wait for the resolution of the truce whenever it happens, resolution of the war whenever it happens, and then allow for a few months for the normalization. We all know that thousands of ships are stuck in the Straits of Hormuz. They all have to come out, go back to their ports, and then refill. All this logistical upset and chaos that has happened will take a long time to come back. Same with oil. So oil went up from the $60-65 that it was a couple of years back to beyond 100 and somewhere around 95 now. For it to come back to the 65 or $70 would take time. One is for the logistical logjam to set right and supply chains to correct themselves again. Second, because of this crisis, countries have realized that they better be having larger strategic reserves of energy. So for some time to come, they will be buying more oil than they need just to store, just in case they face a similar situation again. So I think it would take 4, 5, 6 months after the truce for the situation to resolve. Okay. But markets are forward looking. They will not wait for complete resolution. Even if they get a sniff of a resolution, confidence comes back, markets go back up. So don't try to panic. Be invested.
And yeah, those are all the questions for today.
Fabulous. I think it's been a great time. I hope you've enjoyed this session and the views of the leading lights that we have for you today. Thank you.